Welcome to this week's live strategy session. Thanks for joining me. Great having you with me for another session of talking about the stock market, and heaps of interesting things going on this week with the markets and with the commodities, and also any stock codes you'd like me to have a look at. With so much movement in the individual stocks, get those ticker codes ready, and we will go through those at the end of the show. As always, everything today, general commentary only, no personal advice given. Having been through those, let's get into our first chart. So we will start with the ASX 200 as we typically do, and it's been a mildly positive week for the local market, and it looks like we're going to get back-to-back up weeks. So last week and then this week, 2 weeks in the green, and that's something we haven't seen since back in early February, heading into the market's all-time high. But of course, all of this is happening under the backdrop of declining moving averages. Now, I'm using the 50-day and the 100-day moving average on this chart. So, is this a rally we should trust, or should we be preparing for more selling? I've got a fascinating sentiment chart I want to show you a little bit later, and it highlights how this type of situation can play out. And with that type of knowledge, I think that can then help prepare for what could be coming. I'm also going to show you what often happens when the S&P 500 drops below its 200-day moving average. And I think that also offers some interesting insights when you look at how that happens, and you actually know what to look for when you go through and you look at that indicator. But first of all, let's start with this latest price action. Now, the first thing I want to do, I just want to tidy this chart up a little bit. You can see this support resistance I've had there for a while. It was useful during was quite useful during 2024. Hasn't been so useful during this recent period. So what I'm going to do, I'm just going to remove that from the chart, and I think that's something we should do from time to time. Tidy up charts, take off indicators that aren't working or aren't adding value, take off some of the lines which aren't adding value, and just having a chart with less clutter. So for the second week, investors have been buying the dip. Some stocks have been having impressive rebounds, but overall, the rally still doesn't have a great deal of power to it. It lacks that snapback quality that we've seen with other rebounds. And for example, you just need to go back to the August panic sell-off, where we had the quick sell down, and it was a real snapback rally that came in the days that followed. And not so much this time around. And this is a concern. We now have a market that's consolidating below declining moving averages, which we just noted, and also unable to gain a lot of upside momentum. Now, this isn't to say that prices can't keep grinding higher and then start to get some momentum to them. So that's still entirely possible, but I think we need to respect that we do have a changing technical structure. So rather than a market that is consolidating above rising moving averages, as was the case for much of last year, we've now got the opposite situation. We've got a market that's consolidating below moving averages that are declining, and that creates a vulnerable structure. Now, some people will say they'll say, look, it's just the banks. The banks have caused all this because they've got such a big weighting in the market, and we can quickly go over and look at the banking or the financial index, and you can see the banks have had a 14% decline over that sell down period, and that follows this strong upward trend over the previous year. But I think there's more to this than just the banks coming back, and the banks are a big component of the market, particularly those big four banks. What I want to do, I want to jump over to the equal weight, the ASX 200 equal weight, and just see what's been happening with there, because this is interesting because it removes the impact of the biggest stocks. So if we're going to say this is all due to the four big banks coming back, well, when you put the four big banks in an equal weight basis, they're just four stocks out of 200. They don't have that much impact. So when we do look at the equal weight, ranks everything equally. The rally off the low has been stronger than in the ASX 200, which is a positive factor. But prices have so far stalled below this overhead resistance that comes in at around 1,920. And you can see that captures some previous peaks from 2024, a low from late last year, and now it's the market stalling beneath there again. And of course, the equal weight also, it's got that same structural shift with the price that we can see in the ASX 200, and that is prices consolidating below below these declining moving averages. So this creates that environment with a greater risk of lower levels. So when I say risk of lower levels, it doesn't mean lower levels will happen. It just means the risk is heightened when you get this environment where prices are consolidating below these declining moving averages. I'll show you what I mean. I want to compare this most recent period, the last 6 months. Let's just go back and compare that with another period. So this is going back to the highs in 2021, and it's just in particular this area I want to have a look at. So this was the period where the market consolidated around its highs, had a false break to the top side, then a rapid decline below the moving averages, a rebound to the moving averages, and then over the next few months, prices deteriorated, went into that bearish decline, coming over to what we currently have, and you can see the same structure. A consolidation within a band, a false break, and then a rapid decline, and now consolidating below the moving average. Just put them together on the chart, and you can see how they're similar. Now, this isn't to say the current situation is going to resolve in the same way. I'm not doing it for that purpose. I'm not saying, oh look, this looks the same. Everything's going to unravel. This is a roadmap to what will happen. It's not at all. This will invariably look completely different to this prior period. It'll have its own unique pathway that it follows. But what I'm trying to show by doing this is that ongoing weakness is more likely to develop from consolidations below moving averages. So that's what happened over here in 21. We have consolidations below moving averages, and that led to more weakness. It's just to say it's more likely. It doesn't say that it will happen, but it's more likely when you have those underlying conditions. So I want to doubly stress, I'm not suggesting for a moment that a bear market is coming. As I discussed last week, several months of messy range-bound price action is, I think, entirely plausible at this point. But we need to appreciate that there is a vulnerability to the current structure whilst it is below the moving averages, and we should plan accordingly. I don't think this is a time for excessive risk-taking or letting losing trades get away from you. It's like just keeping a tight rein on risk while we have this current structure. Hopefully it resolves well and prices get back above the averages, but we just need to wait and see whether that happens. So how do you play this? Well, firstly, for me at least, it's about having a plan and following it. For me, that's... For me, the time to be bullish and buying is when prices are rising above moving averages, rising above rising moving averages. I just snap back over to the ASX 200 for this. It's when we have the rising moving averages, that's the time to be bullish. That's when I want to be buying. And when prices are below the moving averages, as we'll invariably get from time to time, it's for me, that's a time to be defensive. I've been continuing to use this week's rally. So I told you this last week, and this week I've just continued to just reduce risk. And I'm still long stocks, and I'm happy to be long stocks, but just less long. And I've actually even added a few positions where signals have warranted this week. So it's not about scampering away from the market. If the right setups are there, I'm happy to put some money into them. But generally, I've been reducing exposure to the market whilst we're in this position. And as always, I'm using those wide trailing stops. And the aim of that is to see off consolidations where possible, but then also have an exit plan should the current situation deteriorate. So give it the benefit of the doubt, see if it can stabilize and push higher. So the wide trailing stops can help us do that. But then they also give us an exit plan should things take that turn for the worse. I think the key now is protecting capital when conditions are difficult, and also remembering there'll be plenty of time to make money when the uptrends return, and they will return. It's one of the few things we can use a will with, because we know as long as markets continue to operate, uptrends will return. We just don't know when, and we're waiting for the market to guide us into a more favourable setup for uptrends to appear. So, if you're getting some value from this, please hit that like button. Please leave a short comment. Just tells YouTube you're watching, and YouTube then shows other people, and that helps me heaps when you do that. So click the like button and a short comment, please. And now let's move into the US, see what's going on over there. And I'll go over to the S&P 500 and the rebound. The rebound in the S&P 500 has continued through the week, but like the ASX 200, it continues to be a slow grind off the low. We're yet to really see any of those powerful buying thrusts, which often happen when the market does decidedly take a turn to the positive side. We see a strong push into the market. We haven't seen that of yet. Of course, buying can quickly intensify, just like we saw in May last year. So if you come back to May last year, look at this period in May. So we had the pullback to the moving averages. Prices were really struggling to get moving. It was a lackluster bounce off the averages, but then the buying quickly intensified, and then things were up and away again. So it can come back in quickly, even though it hasn't happened as yet. But the difference, of course, now to what we saw last May is that whereas in May prices were coming back to rising moving averages, this time around we're now below moving averages, which are declining. So I think we need to be on guard whilst this structure persists. And as I'm at pains to point this out, vulnerability doesn't have to be a bearish outcome. But when the bad stuff does happen, it tends to happen when prices are below declining moving averages. So as I say, I think we just need to be on guard whilst this vulnerable setting persists. Now, what I want to do now, I want to switch moving averages. So I've got the 50-day and the 100-day moving averages on this chart. I'm going to take them off, and I'm going to replace them with a 200-day simple moving average. So I usually use exponential moving averages, but with this we're going to use a simple moving average. They don't make that much difference over time either when you use exponential or simple, but nonetheless for this I'm using a simple moving average. Now, what's interesting with this, it's interesting to look back at other times when the market got below the 200-day moving average. So I'm just going to compress this up a bit. I'm just going to scroll this back. I'll only scroll back as far as the GFC. You can actually do this yourself, and you can go all the way back through the 60s and 50s and so on. But I can make the point I want to make with the just going back to the GFC period. So as I come back, you'll notice we occasionally get the sharp declines below the moving averages. Like you can see one just here from 2023, and then they're followed by a quick rebound. You're going to notice some lengthier periods below the moving average. Don't worry about them at the moment. What I'm focusing on, it's just those quick excursions below the averages and the rebounds. and we just go back through time, and here's another one here in 2019, and then we get a few through there in 2018, 2016. So these are all times when the markets quickly come back, up at a high, it's quickly come back and it's quickly rebounded. There's another one in 2012 again, and you can see there again 2010, and then we make our way back to the GFC. We can keep going back and playing that game, but we won't do that. I just wanted to point out how that plays out. Now, what you'll notice is that if the market's going to have a quick rebound, so now just look at these rebounds in a little bit more detail. If the market's going to have that quick rebound, if that's going to happen, it tends to happen within a few days. And you can see these are just quick rebounds below. Doesn't hang around here for too long. And in situations where the S&P 500 stays below the 200-day moving average for a few weeks, so we're getting 2, 3, maybe 4 weeks, then it tends to be a warning of a longer stay below the 200-day moving average. So you can see, here's a great example from 2010. Market, it was a soft rebound. It couldn't gain much momentum. It's below there for a couple of weeks, and it was a sign it was going to be a lengthier stay. Same occurred in 2011, and you can go through and you just look at all these periods where it's lengthier stays, and it's where we don't get that quick snapback rebound. If it hangs around for more than a couple of weeks, there's a tendency for prices to spend more time below the moving average. And so what does a longer period below the 200-day moving average means? Well, it could mean a bear market like we saw in 2022, or worse still, the bear market we saw in the GFC. That all eventuated from spending more than a quick time below the moving average, the 200-day moving average. Or it could just mean a messy multi-month consolidation like we saw in 2019. And like that early one I showed you from 2020, 2010, or here's another one in 2015. You get these multi-month messy consolidations that don't develop into large bear markets, but become difficult periods. That's what tends to happen when we spend too much time below, when the market's too much time below the 200-day moving average. So we're currently in the situation where it has been a couple of weeks of mostly below the moving averages. So we're now moving in that position where those longer consolidations become more likely. If prices quickly get back above the moving averages next week, maybe we can say that's been disengaged. That's what I'm watching for at the moment. Is there going to be another week or two below the averages, which then increases those odds? So if we do see more time below the 200-day moving average, which is more likely, the big consolidation or the bear market? And I just don't think we can tell. We can identify setups that have a higher probability of leading to trouble, but we can't see the future. And I know that frustrates some people, and they tell me in the comments, they'll tell me that I say things like this could happen or that could happen. And I do that all the time because I don't know the future. So I'm outlining possibilities. That's how this works. There's no certainty with anything when we're looking at indicators, we're looking at charts. None of them tell us what's going to happen. They don't tell us the future. That's not how this works. But I think if you can understand the possibilities, then you're in a better position to prepare for them and not be driven by headlines and by panic and by emotional decision making, because you've got a better understanding of how things can work out, and you can have plans in place to prepare for whichever. It could be this or it could be that. Well, if it's a lengthier decline, we've got a plan for that. Exiting positions, trailing stops. If prices break back higher, then we start to get bullish and start to enter positions. So depending which way it goes, there's a plan that will then follow on. As I was saying with the ASX 200, I think now's a time to play a more defensive game until prices can sustain a move back above the moving averages. and this could all blow over in a few months. But until we have a more positive price structure, I think it's time just to respect risk, because there is elevated risk when prices are below either the 50 to 100-day moving average, which I usually use, or now this longer term 200-day moving average. Just while we're talking about the 200-day moving average, for that matter, it reminds me of a quote from a famed Wall Street trader, a guy called Paul Tudor Jones. You can look him up, fascinating guy. And one of his famous quotes is, he said, "Nothing good happens below the 200-day moving average." And well, we've been through that. We are currently below the 200-day moving average. It's not a magic line in the sand where everything changes, but it's a point of elevated risk. I just think now's a time for caution, knowing your exit strategy. If prices rally from here, then that's great. But I think we need to have our downside covered in case the situation worsens. And now I want to show you one more thing before we move on from the US markets. Really interesting graph turned up in my turned up in my X feed during the week. It's from the guys over at Sentiment Trader, and so let me just enlarge this. And what it is, it's all about. It shows how bearish sentiment typically reaches extreme levels and notable lows. So just look at how this. So at the top, we've got the S&P 500. The indicator below there, it's showing the percentage of bears in the American Association of Individual Investors survey, and then below there, it's an indicator showing you a consecutive number of weeks the bears have been above 50%. It says days here, but I think they meant to say weeks. And so this dashed line is 50%. So when the indicator is above the dashed line, it's showing there are more than 50% of bears in the survey. And then, of course, when you run your eye along, a high number of bears typically coincides with key low points. So that's how sentiment often works. And then this lower one, this is showing they're showing when there's been 5 consecutive weeks or more above 50% bears, and they're highlighting a notable low, and they've got another notable low in 22, another notable low. Is it going to be now? Because this indicator is triggering. There's been 5 consecutive weeks of the bears above 50%. There is historical precedent of this being a low point. So yes, this could be another low point now. So that's an interesting thing to be aware of. And yeah, bearishness is currently at an extreme, and that's all good. The worst could be behind us. But the point I want to make with this is that extremes are a useful indicator. I think they can be a great guide. I use them myself. And the same applies when you look at RSIs. They can be a useful indicator, but I also want to couple a sentiment indicator with positive price action. And that's because an extreme situation can always get more extreme. Just have a look at these 3 spikes in the middle of this graph in the lower section. Look at the 3 spikes in the middle. Now, this is during the GFC decline. The first 2 spikes were in the early and mid stages of the decline. So in this situation, it's an extreme which got more extreme. And it wasn't until we got this last low that the extreme actually did lead to a lasting low and a turning point. So yes, take notice of sentiment surveys when you see them. I think they're interesting and useful, but I'd suggest thinking twice before buying simply due to negative sentiment. For me, bearish sentiment is a setup, but positive price action is the trigger. Coming back just to wrap this up with the S&P 500, a lot of technical damage has been done over the course of this sell-off. Just switching those moving averages back over. So a lot of technical damage done. I think a multi-month period of messy price action is entirely possible. Maybe the low gets retested, maybe it doesn't, but I think that messy price action, I think there's a good chance that's what we're heading towards. A lot of ways this could play out, and they aren't all bad, but I think a defensive approach is probably the way to go until we get that clearer price structure of prices back above moving averages. Okay, so we're going to move on to the US small caps next, and we've got the local small caps, the all ords, or the small ords, the emerging companies, all the commodities. Going to go through your stocks, but of course that wraps up the free section. If you're not a strategy session member, there's a link below. Click that. Come on in. Heaps of interesting stuff. Costs you very little, and I think from the feedback I get anyway that you'll get a lot of value for the small contribution it takes to put all this together and keep the show on the road. So, okay, let's go over. We'll start with the Russell.